Good afternoon, everyone, and welcome to the bank's Inflation Report press conference. On my left is Dave Ramsden, the Deputy Governor for Markets and Banking. On my far right is Ben Broadbent, the Deputy Governor for Monetary Policy. And on my immediate right is the Governor, Mark Carney.
Thank you, Gareth. Good afternoon, everyone. The Bank of England has increased bank rate for the first time in a decade, raising it by 1/4 percentage point to 0.5%. And what I wanted to do in my brief remarks this afternoon was to address three questions around that. First, why have we done it? Why has the MPC raised interest rates? Secondly, what will be the impact of the change? And third, what will happen next? So starting with the first, why has the MPC raised interest rates? The MPC's primary objective is price stability, defined by the government as a 2% CPI inflation target. CPI inflation was 3% in September, and it's expected to have risen a little further in October. But it isn't so much where inflation is now, but where it's going that concerns us. The MPC must set policy to achieve a sustainable return of inflation to target. That is, we must aim to bring inflation back to target and to keep it there once the effects of temporary factors, currently predominantly those caused by the referendum-related fall in sterling, dissipate. So in many respects, today's decision is straightforward. With inflation high, slack disappearing, and the economy growing at rates above its speed limit, inflation is unlikely to return to the 2% target without some increase in interest rates. Of course, these aren't normal times. Brexit will redefine the UK's relationship with our largest trade and investment partner, and it will have consequences for the movement of goods, services, people, and capital, as well as the real incomes of UK households. The MPC has repeatedly emphasized that monetary policy cannot prevent either the necessary real adjustment to new trading arrangements or the weaker real income growth likely to accompany that adjustment. We can, however, support the economy during the adjustment process. In such exceptional circumstances, the MPC is required to balance any trade-off between the speed at which we return inflation sustainably to target with the support that monetary policy provides to jobs and activity. At the time of the referendum, the MPC set out our framework for doing so, and we've followed it consistently ever since. The MPC's assessment of the outlook for inflation and activity published today is broadly similar to our projections 3 months ago. In our forecast, conditioned on the gently rising path of bank rate implied by current market yields, GDP grows modestly over the next few years at a rate just above its reduced rate of potential. Consumption growth remains sluggish in the near term before rising in line with household incomes. Net trade is bolstered by the strong global expansion and the past depreciation of sterling. Business investment is affected by uncertainties around Brexit, but continues to grow at a solid pace, supported by strong global demand, high rates of profitability, the low cost of capital, and the limited spare capacity. The MPC judges that there's a little less slack at the start of the forecast period than in August. More fundamentally, the pace at which the economy can grow without generating inflationary pressures has fallen relative to pre-crisis norms. This reflects persistent, and I underscore persistent, weakness in productivity growth since the crisis, and more recently, the more limited availability of labor. Over the next few years, modest demand growth is expected to use up the little spare capacity remaining in the economy, and domestic inflationary pressures are likely to build. With unemployment at a 42-year low, inflation running above target, and growth just above its new lower speed limit, the time has come to ease our foot a little off the accelerator. That will help bring inflation back towards its 2% target while still supporting jobs and growth. So what will be the impact of this change? Changes in interest rates work through several channels. Rate increases obviously reduce the current cash flows of borrowers and increase those of savers. Interest rate increases also make it more attractive to save today to consume tomorrow, and less attractive to borrow to spend today. and interest rates are one of many influences on exchange rates and other asset prices. While the sheer novelty of the first increase in bank rate in a decade creates some uncertainty around its impact, there are reasons to expect it to be no larger than usual. Households are generally well positioned for a rate increase. More people are in work than ever before. Only about a fifth of people with mortgages have never experienced a rate increase. Of those, almost half of those took out their mortgages after the FPC introduced its affordability stress in 2014. And I'll remind that that affordability stress requires mortgagors to be able to withstand an increase in their mortgage rates to around 7 percentage points. Fully 60% of mortgages are at fixed rates. And even with this bank rate increase, many households will refinance onto lower interest rates than they're currently paying. And I'll give you two illustrations of that, by around 30 basis points for those moving off expiring two-year mortgages, and by almost 2 percentage points for those moving off 5-year deals. Company balance sheets are generally in strong shape, with the share of profits required to meet monthly debt repayments falling to its lowest level in more than 2 decades. Financial conditions remain highly supportive, and demand is growing strongly in the rest of the world, robustly so in our largest trading partner. So what will happen? Pardon me. What will happen next? As always, the committee will monitor closely the incoming evidence on the economic outlook, including the impact of today's increase in bank rate. To be clear, even after today's increase, monetary policy will provide significant support to jobs and activity. And the MPC continues to expect that any future increases in bank rate would be at a gradual pace and to a limited extent. Current market yields, which are used to condition our forecasts, incorporate 2 further 25 basis point increases over the next 3 years. That gently rising path is consistent with inflation falling back over the next year and approaching the target by the end of the forecast period. The MPC will, of course, react to developments to the extent they affect the outlook for inflation and activity. And in this regard, Brexit remains the biggest determinant of that outlook. The decision to leave the European Union is already having a noticeable impact. The overshoot of inflation throughout the forecast predominantly reflects the effects on import prices of the referendum-related fall in sterling. Uncertainties associated with Brexit are weighing on domestic activity, which has slowed even as global growth has risen significantly. And Brexit-related constraints on investment and labor supply appear to be reinforcing the marked slowdown that has been evident in recent years in the rate at which the economy can grow without generating inflationary pressures. The impact of Brexit on the forecasts will evolve as negotiations progress. In particular, a reassessment of the economic outlook would be prompted by any resolution of the uncertainty about the nature of or transition to the UK's future relationship with the European Union, insofar as those changes affect the behavior of households, businesses, and financial market participants. While the direction of that reassessment for activity and inflation is not automatic, the MPC's response will be consistent with its remit and the framework we followed since the referendum. By continuing to balance the trade-off between the speed at which inflation is returned to target and the support that monetary policy provides to jobs and activity, monetary policy will continue to make its best contribution to the prosperity of the people of the United Kingdom. And with that, Dave, Ben, and I would be pleased to take your questions.
Okay, could I just, as always, remind you, please give us your name and the organisation you represent, and you will need to keep to one question only for the first time we go around, please. Kamal first.
Kamal Ahmed from the BBC. Governor, for many millions of people today, their cost of living will go up. You've got real incomes falling. You've got the economy subdued. For people struggling to make ends meet, can you understand that they simply won't understand why you have decided to raise interest rates today. And Sir David, if I could just briefly ask you why you disagree with the governor.
The first thing I'd say is that the rate of growth is slower than historic norms, but it's not subdued. I think we have to get used to an economy. After all, this is an economy that's operating with unemployment at a 42-year low, more people in work than ever before. This isn't a false read on the unemployment rate. People are in the labor market, they're working, and the degree of spare capacity in the economy is very limited. So the question about the speed limit of this economy going forward will be increasingly determined by the rate of productivity growth, which, as you know, has been very slow since the crisis and is expected to be so going forward, even though we have some pickup. But to take a step back, look, what we're doing is easing our foot off the accelerator. This is a modest adjustment in interest rates. It will have an impact on borrowers over time. It will have a more immediate positive impact on savers in terms of deposit rates. It leaves monetary policy in a position where it still is highly supportive of jobs and activity, and you can expect it to have, in fact, it is the policy that is providing a boost to the economy relative to headwinds from other policies, including fiscal policy and the uncertainty associated with Brexit. In terms of households' financial positions, they have been difficult, as you know, over the course of this year with the real income squeeze. The worst of that real income squeeze is ending, and this is part of ensuring that it doesn't come back. In other words, ensuring that inflation returns to that 2% target in a sustainable manner, in a way that supports the economy, in a way that supports keeping people in work and moving forward. In terms of Dave?
Thank you, Governor. All of us are here, as is always the case, to explain the decision that the MPC has taken today. Reflecting our commitment to transparency, you'll see in the minutes that there's a paragraph setting out the high-level view of the two members of the MPC who didn't vote for an increase in bank rate. I'll have plenty of opportunities in the coming period to explain in more detail my position, but today is about the MPC's decision.
Phil and then Ed. So, Phil on the side there.
Hi, Phil Aldrich at The Times. It's the first rate rise in a decade, but I think the last time there was a rate rise cycle was about 14 years ago. And I just wondered if, all other things being equal, we don't get any sort of surprise negotiation outcomes of Brexit. Could we see this as the start of a rate rise cycle?
Yeah. Well, the first thing to say is that as we've stressed in all our communications in the forecast, I stressed in my opening remarks, our forecast is conditioned on a market curve which has 2 additional rate increases over the forecast horizon, and we in fact need those 2 additional rate increases in order to get that return of inflation to target. And in fact, if you look closely at the forecast, inflation approaches the target. It doesn't quite get there. And the economy is likely to be in a position of excess demand, in other words, running a little hot at that point. So the judgment of the committee has been that that's the right way to balance the trade-off at this point. There's another way to illustrate the point, which, I mean, you'd be familiar with, Phil, that we release another forecast, which is just one that has a constant rate. Now, the constant rate is at the 0.5 percentage point, the rate at which we've just moved bank rate. And if you look at that out to 2 years, inflation's just below 2.5%, and the economy, unemployment is less than 4%. The economy is running above its potential rate of growth. I would remind, and that strikes as a trade-off beyond the tolerance of the MPC, to be clear. I would remind of one other thing, which is that our normal horizon to return inflation to target is 18 to 24 months. Because we're in exceptional circumstances, because there are these headwinds to the economy because of the real income shock and uncertainty and other factors, we have stretched out that horizon over which to return inflation to target. But there are limits to the degree that we can do that. And certainly when the economy is in a position where more people are working than ever before, when there's a very limited spare capacity in companies, and when the speed limit or the rate of potential growth, rate of productivity, different elements of the same thing, saying the same thing, is quite muted. It does require some recalibration of monetary policy. Last point, at the start, you said an important caveat, which is subject to some major development on Brexit. And as I said in my opening remarks, and we said in the MPS, if there is resolution of some of the big questions around Brexit, transition deal on the end state, you would expect that to affect how the economy functions. You would expect that to change the economic outlook, and if you have those two components, you would expect some recalibration of monetary policy at that point. Monetary policy has the advantage of being the most nimble of the macroeconomic levers. I would caution, though, that the consequences of resolution on Brexit are not, this is something we've said since before the referendum, are not automatic for the path of inflation. Doesn't necessarily go in one direction.
Hugo at the front here, and then Ed.
Thank you. Hugo Duncan from the Mail. Governor, what impact do you expect this rate hike to have on savings rates? Should banks, building societies and others be passing this on in full to savers?
Yeah, Hugo, we would, and actually I'll ask Dave maybe to supplement a bit. We do expect it to be passed on. Banks did pass on the cuts to their depositors, and we expect competition to push it in the other direction. And obviously we watch it closely. I would say as well that in terms of the short-term dynamics, since there's a lot of fixed rate mortgage debt, as you know, which isn't going to change in the short term because of the bank rate increase. And actually most consumer credit is relatively insensitive to the level of bank rate because there's so much spread on top of it. I mean, if credit card fees are in the high teens percentage points, exactly where bank rate doesn't make a big difference to it. And of course, student loans are unaffected by this. But on the savings side, we would expect pass-through, and Dave, I'll ask you to supplement.
Already we're seeing, reflecting what's been happening in markets, that the average rate on fixed rate saving products has been going up this year. So on 1 and 2 year fixed rate bonds, we've seen increases of 0.2 and 0.4 on the rates between January and September this year. So we're already seeing some anticipation.
Okay, Ed, and then Jason behind.
Ed Conway from Sky News. One of the interesting points that you've talked about is the potential supply growth estimate being at 1.5%, potentially quite a bit below where it would have been previously. Can you explain how much of that is down to long-term secular trends, UK productivity trends, and how much of that is a Brexit effect?
Yeah. I'll start, pass to Ben to flesh out. The first point is the big news this issue has accumulated since the crisis, as you recognize. The long period of lower investment, long period of poor process investment, if I can put it that way, poor total factor productivity growth, and what we had, and it didn't really matter for the speed limit of the economy. For a period of time because we had so much spare capacity in the labor market. And there's a chart in the inflation report, I think at the start of chapter 3, which shows that basically all of the growth had been supported by an increase in labor supply. Well, we're getting to that point, not surprisingly, with the unemployment rate at 4.3, with participation rate very high, with a shift in a lower rate of net migration. All those factors means there's just much less labor supply come in. So these longer-term factors are starting to bite. Yes, Brexit has, so that's the biggest part of the story, to be clear. The productivity puzzle is the biggest part of the story. It has been reinforced over the course of the last year by some of the Brexit effects, and they're twofold. One is just less investment, and I think we've pointed this out in the past, but basically if you look at our May 2016 forecast for investment relative to our August forecast and this one, which is broadly the same, it's about an 18 or so percentage point difference in the level of investment at the terminal point of the forecast, the common terminal point in 2019. And then the second thing is around total factor productivity or process investment, and we talk a bit about that in the report. One of the challenges, which is just starting to show up, and again, it very much depends on what type of final arrangement is negotiated, is a supply chain effect and some of the knock-on effects on total factor productivity. So we are seeing some of that. I would just reinforce that what we're saying is, I'm going to reinforce that this is reinforcing something that has been there, as opposed to it's something that's totally new that just started in last summer. But
yeah, no, I'll just flag again the graph that the Governor mentioned. It's on page 22, and it makes pretty clear, I think, how unusual this period is, how much of the growth, almost all of it, over the last decade, since the crisis at least, has come from increasing labour supply, a bit on average hours, mostly employment growth, not from productivity. There has been a period, a 10-year period in the UK when you haven't had any productivity growth, but you have to go back to sometime in the 1860s or 70s to see this. So it's a long-standing trend. It's not unique to the UK, although we've probably felt it more severely than others, right? So productivity growth has slowed in just about every advanced economy since the crisis. But we've had it's been more severe in this country than others. And I think the committee has identified on top of that things, as the Governor said, since the referendum that are probably reinforcing that trend and will continue to over the next couple of years. One other thing I'll point out, we have not changed that view since August, right? So this is not a new development since August. It's not something we've suddenly done and for that reason decided to raise interest rates. What is clear is that the consequence of this is that unemployment has continued to edge down, and that is just one sign of the fact that the slack in the economy has narrowed. That blue bar in that chart doesn't have much room to contribute on the sort of scale it has done over the last few years.
Okay. Jason and then Simon. Sorry, the microphone at the back there. Thanks.
Hi, Jason Douglas from the Wall Street Journal. This increase in bank rate is coming at a time when the Federal Reserve is also raising interest rates, when the European Bank is signaling that it is going to begin paring back its stimulus in January. And I suppose my question is, are we having a bit of a moment in central banks sort of post-crisis when people are beginning to move together to withdraw some of this stimulus? And do you feel part of that, or is this really just responding very much to the peculiar situation of the United Kingdom? Thank you.
well, look, the global economy is firing on, I think we say most cylinders, although I think we need a 12-cylinder engine to say most cylinders. I mean, it's 11 out of 12. The global economy is doing very well. I'll just draw your attention to capital goods chart that is almost off the charts in the report. So it's not surprising that as growth is picking up in a number of jurisdictions that the stance of policy is changing, and it's not surprising for those economies that are particularly open that it's having some influence. So all of that is there. It creates some possibility, and that's some possibility of a movement in upwards over time in equilibrium rates as well. I've made the point particularly the extent to which this is an investment-led or a heavy investment component to the global recovery. The UK is participating a little less in this global upswing. We are participating in it. Net exports make an important contribution to growth. Investment is stronger and it's helped by that global growth. It's not as strong as it normally would be. And we are going through a period, in part caused by the fact that we picked up earlier than Europe, but I think in part caused by idiosyncratic issues here. It's a relatively unusual period of underperformance for the UK at a time when the global is, at least the G7 is doing as well as it is. So, synchronized pickup globally, it makes sense. Everyone obviously bound by their own situations, and we have certain unique elements here that we're grappling with.
Okay, Simon at the front.
Simon Viger, 5 News. A lot of people watching this will be delighted and maybe a bit surprised that you think wage growth is going to pick up. Can you explain why you think it's going to?
Sure. We think a couple of things. I'd make 2 points on the real income squeeze. Obviously, there's 2 elements to that. One is that inflation coming down, and then your question about wage growth picking up. Let me just be clear on the former. The first element of, we do see inflation going a little higher in October, but then as we get into the turn of the year, some of the base effects, use that terminology, but I just lost your viewers. But we see it easing off in 2018, and the question is finishing the job and bringing it back to that 2% target over the right horizon. In terms of wage growth, it starts with a labor market that is tightening. The unemployment point I've made, we do see that a variety of indicators that show greater tightness in the labor market. Vacancies are at elevated levels relative to post-crisis. The level of churn, so-called churn in the job market, has picked up quite sharply. So people are taking risks, moving to new jobs, moving between firms. That's a healthy development. And in fact, if you adjust for self-employment, which has gone up, it's more or less back at pre-crisis averages, so that's a positive development. We see that wages for new hires are notably higher than existing wages, so there is that differentiation. But of course, as more people are moving between firms, it can fill out. There's quite strong survey evidence, and I would single out particularly our survey evidence, the survey of the bank agents. So a year ago, when we were sitting here, the view of our agents based on the company visits and the surveys that they do was that wage growth was not going to pick up in 2017, and they were right. And it's actually quite an effective survey. In fact, it is now, the new survey is that wage growth will pick up in 2018. So there are a variety of factors that suggest it. One of the requirements, though, for wage growth picking up, which we shouldn't underestimate, is that productivity picks up as well. One of the reasons why wages have been weak is productivity has been weak, and we do expect some pickup in productivity associated, not least with a pickup of investment and a sort of shift between labor and capital. And then the final point is the nature of the jobs that are being created. Part of what we've seen is so-called compositional effects. The nature of jobs have been lower wage, lower skilled jobs, or the people who have filled them haven't had the skills yet, and that's had we think a temporary effect on wages. So we do see a pickup, Simon. It'll gradually build through 2018 into 2019, and the only thing I don't want to mislead is that the rates of wage growth we see towards the end of the forecast are still below historic averages. So we're talking about 3.25 type percentage point increases in wages as opposed to north of 4%, which people would have been used to prior to the crisis. Do you want to?
No, I only wanted to say, obviously we've been disappointed by this before. We've said we'd expect it to pick up in the past, and it hasn't. The main reason for that has been disappointments on productivity. What is true, the MPC still believes, and I think the evidence still clearly suggests, that there is a kind of Phillips curve. You would expect, as the labour market tightens, for that to have some effect on wage growth, and we think we're seeing signs of that. One other point, if I may, which comes back to a question of Kamal's, you should be careful about looking at annual growth numbers, certainly, say, for wages. The latest data we have are what happened to wages between the summer of 2016 and the summer of this year, and then saying real incomes are still falling. Now, that's quite a backward-looking thing. The worst part of that squeeze was actually in the early part of this year. And right now, if you look at what's happening right now, household incomes in real terms are roughly flat, maybe even edging up slightly. So we think we're past the worst already. Prospects for next year depend critically, as the governor said, on productivity again. But given that, we also think there's some effect of narrowing slack on the prospects for wage growth.
Okay, Ben, and then if you could pass the microphone one back when you're done.
Ben Chu from The Independent. Governor, I want to raise the issue of policy mistakes. 10 years ago, when the bank last raised rates, it had to cut them again within 5 months. In 2011, when the ECB raised rates, it had to cut them again in an equally short amount of time. If the Bank of England does end up reversing this rate hike over the coming year, how should we think about that? Should we think about that as a nimble response to an unforeseeable or low probability event? Or would we be justified in calling what you've done today as a mistake?
Let me reflect on that for a minute, Ben. I vote for nimble response. I'll check with my colleagues. Look, I think the way to judge it, so let's talk about the most likely reason for an adjustment in policy in either direction. And I really want to stress that if you take one thing away, in either direction, with if there is some form of resolution around the big issues around Brexit, either having a transition deal or much greater clarity about the end state. And the parties are working hard in the negotiations to solve both of those issues. So when that becomes known, the answers to those questions, almost certainly that is going to have an impact on the way businesses and households but think about the future, think about their investment plans, spending plans. It will have certainly an impact on a range of financial asset prices, notably the exchange rate. And we as a committee will have to step back and assess the new outlook and calibrate policy appropriately. If that's an acceleration in the pace of raising interest rates, because the balance of demand and supply and exchange rate effects warrant it, that is an appropriate response, nimble, appropriate response. If it requires some more support for the economy, again, because of the mixture of those exchange rate supply and demand effects in our judgment, that again is a nimble, appropriate response. That's adjusting to a change. And the way I'd suggest we would suggest to think about it is we have laid out as best we can our framework for to living in these uncertain times or these exceptional times and adjusting policy. Since August of 2016, we have very clearly laid out how we think about the trade-off. And now there are a series of decisions around that, which started with the initial decision to provide stimulus in the wake of the referendum, including guidance on potential for additional stimulus if the forecast went in a certain direction or if the outturns went in a certain direction. Then a series of decisions to hold policy, including at times when the trade-off went in an adverse way so that inflation had a bigger overshoot farther out relative to what we were gaining in terms of jobs. And then the decision today about, in effect, the limits of that tolerance for the majority of the committee, which again is information about how we would react. And different people are going to have different views about the probability of an agreement, the impact of an agreement on the economy, but they have increasing information about how the MPC will view the trade-offs that are involved and the calibration of policy accordingly.
I mentioned one other statistic worth remembering. We've come from this extraordinary period where we've been up against the lower bound, and so interest rates haven't changed. Go back before the crisis, interest rates used to change on average every 4 months, I think. And the average interval between the last move in one direction and the first in another was maybe 7. So you say in the next year, but in times before we were at these very lower levels, these changes weren't uncommon, nor were, and one has to respond to events as they come along, whichever direction.
Mona Bersachi from CNBC. I just wanted to ask whether you've had any discussion about the reinvestments of gilt proceeds. In the past, you've alluded to 2% as being a rate where you would probably think about stopping reinvesting the proceeds. Mr. McCafferty has referred to 1% as being more appropriate, and obviously the Fed have started quantitative tightening at 1.25%. So has there been any discussion about this?
Well, for the purpose of today, I just leave at the guidance that the MPC gave a few years ago, which is a couplefold. One is that we want to use bank rate as the marginal instrument of policy. We would like to be in a position where we could go through effectively a conventional rate cycle, which implies bank rate being notably higher than where it is today, and that we've just taken a decision today. I don't want to inadvertently send a signal about something that would be much further down the track, given those first two requirements or principles, if you will, of the MPC's approach. Thanks.
Okay, Larry, front here and then.
Larry Elliott of The Guardian. You started your remarks with three questions. Can I ask you a fourth question? Why now? Because the report doesn't really say there's been any material change in the economy since the last one. A lot of the inflation we've seen over the last year has been caused by the one-off impact of sterling's devaluation, which will wash out of the system. As the MPC itself says, there's a lot of Brexit uncertainty affecting the economy in a negative way at the moment, and that uncertainty may well dissipate over the coming months. So why does the MPC feel the need to do this right now rather than wait to see what happens in the economy over the next few months? Because while acknowledging that at some point falling unemployment will actually lead to higher wage growth, you have been saying that for quite a long time, and it hasn't really materialised.
And well, a couple of things on that last point. One of the things you've seen, and it's detailed in the report, is that labour costs have picked up fairly steadily. So even though wages have picked up somewhat, and most of the pickup is in the surveys as opposed to in the pay packet. Recognize that, but unit labour costs are running just below target consistent levels. Because non-wage costs have gone up a bit. Now, short term, we think that's going to come off for a variety of reasons, and that's detailed in the report, or it's flagged in the report. But you do see some build, and again, we can, Ben, if he wants, can go on a bit about that. But let's go to your, the premise of one of the premise of your questions, which is things haven't really changed. First, we have, as a committee, and at slightly different speeds and slightly different degrees as the individuals, as you'd expect, because people have a slightly different view of the economy. As a committee, have been moving towards the limits of our tolerance of the as the trade-off has diminished. I'll remind again, our job effectively is to get inflation back to target in an 18 to 24-month horizon. That's the normal horizon. We stretched it out to 3 years, and even then had an overshoot, because we didn't want to take a risk with jobs and activity at a time under these exceptional circumstances, because a large part of that overshoot caused by sterling, and that was a fundamentally driven move in the currency. But once that trade-off goes away, once it diminishes, and it's almost gone, the justification for an inflation targeting central bank to continue to overshoot, to continue to miss its target 3 years out, disappears, unless you have a view of the economy that is going to reemerge for some reason. And the committee has flagged the limits to its tolerance. Some members started voting to raise interest rates a few meetings ago. We flagged again in August that we felt that the accumulated evidence about the slower rate of potential growth. We flagged in September that if the economy continued to perform roughly like the August forecast, that we felt that it would be appropriate, given that the trade-off would have largely gone, that it would be appropriate to withdraw some stimulus. And what's happened since August is the economy, if anything, has performed slightly better than our forecast in August. So there's not really a surprise. And on the waiting point, you can always wait. But you have to have the discipline, ultimately, of the target. And if you're deviating from the target, you have to get something for it. And we have stretched in order to get quite a bit for it. 325,000 jobs, supporting growth, supported by other factors. But to repeat myself, as you get to the end of that trade-off, you're not getting anything to it except for missing your target farther out. And I'll finish with this, which as we go into Brexit, we want people to rely on two things out of the Bank of England. One, I'm not going to have to worry about inflation because it's going to be around that 2%. We will do what's necessary and only what's necessary to get it to 2% and support the economy while we do it. And I can rely on the core of the financial system. The banks are going to be resilient and healthy, which is the subject of a press conference here in about 4 weeks when we release our stress tests. They have lots of other things to think about. Businesses have lots of other reorientation to do. There's opportunities, there's risks, all that. Households, could be worried. But these two things we got to deliver. And waiting doesn't, in this case, in the judgment of the MPC, best collective judgment of the MPC, doesn't deliver that.
Okay, in the front here.
Lucy Meakin, Bloomberg News. I just wondered, are you comfortable with the current market pricing for future rate hikes that you mentioned was part of the forecast?
Well, it sort of repeat a bit of what I said earlier, which is that we condition our forecast on the average curve that went into the forecast, which had effectively two additional rate hikes over the course of the next 3 years, and using that. And with all other factors, we see inflation approaching the target, staying a little above at 3 years. And I'll reference what I just said to Larry in that regard, and the economy running a little above its potential rate of growth. So broad brush, it gets you roughly where you want to be, but there may be some difference of view on that in the fullness of time. And then the second thing, what clearly doesn't get us back to appropriate management of the trade-off is arguably illustrated by the constant rate forecast, which leaves inflation notably or materially above target, and the economy in excess demand.
Chris, and then Harry.
Chris Giles from the Financial Times. Perhaps the biggest reason for the rate hike you've explained today is the very low supply capacity of the UK economy, the potential growth rate of 1.5%. This is really quite an outlier among independent forecasters. The independent forecasters are about 1.9, the OBR is significantly higher. What do you have to say to people like Boris Johnson who say you're just a pessimist, you're not being optimistic enough about the UK economy, or Jacob Rees-Mogg who would say you're an enemy of Brexit and you're doing this out of spite?
No, this first thing, let's not personalize it. Okay, so I'm going to ignore the last bit of your question. So this is not a message to any specific individuals. The message to the people of the United Kingdom is that the Bank of England, the MPC, is doing its job, which is to bring inflation sustainably back to target while supporting jobs and activity in this time. And so we recognize that people are going through a real income squeeze. It's starting to ease off. The worst of it is easing off, and it's starting to turn, as Ben Broadbent mentioned a moment ago. And we don't want it coming back. So we don't want inflation. We want inflation coming back to that 2% target in a sustainable way. And that is going to help make Brexit a success, as is making sure. And again, it's a subject for another day, but as is making sure that the core of the financial system is resilient to any potential Brexit outcome. So both of those things work in the direction of what people would expect, which is that we're focused on making Brexit, our contribution to making Brexit a success, whatever deal or in terms of transition or end state is negotiated between the UK and the European Union. In terms of potential growth, I'll turn to Ben to go through the details. But the one thing, just on a high level, and I know you know this, Chris, but is that the labor supply, we're running out of road on labor supply. I mean, unemployment, as again, very low, participation rate very high, net migration less than previously, notably less than previously. There's just less labor to come into the market. It all turns on productivity. I think you'll find that our productivity forecast is not that dissimilar from the OBR's in terms of the OBR's new productivity forecast, which came out, well, you'll know better, 9 the last month. And we have that recovery in productivity over the forecast, albeit not to historic averages, but that's, in our judgments, quite prudent, having been persistently disappointed on productivity, number one. Number two, recognizing lower investment that is happening in the economy relative to what would be needed to materially move it up. And number three, from company visits and surveys and other aspects, recognizing that some of these challenges in terms of the reorientation of activity from Europe to rest of the world, the early stages of that are weighing a bit. But Ben.
Yeah, can I just begin by saying I don't think we should pick out one reason alone. Well, what matters in a very broad sense is demand growth relative to supply. So you could just as easily describe this as, we've had some positive news over the last year, certainly on consumer spending. Investment has been weaker than it otherwise would have been without Brexit uncertainties, but has still grown. The rest of the world, perhaps most, just as importantly, has seen a really marked pickup in growth. Certainly on a UK-weighted basis, it's very strong. And all that has helped the UK relative to a position where we've got sluggish productivity growth. So it's a two-sided thing. Secondly, as the Governor emphasised earlier on, this is a long-standing trend in productivity growth. It's not new. Even our near-term forecasts on productivity have not changed in the last 3 months. They're pretty much identical to where they were in August. I don't know what others are forecasting. I haven't seen a consensus number on trend growth. It may be that some of the differences involve labour supply. Our forecasts on labour supply are pretty transparent. We take the population growth estimates and the migration growth forecasts from the ONS, and the consequences flow through for overall supply growth. And lastly, just to remember on those productivity growth forecasts, they do involve faster growth over the next 2 or 3 years than we've seen for many years in the recent past. So I don't think they're exaggeratedly low, and nor are they new.
Okay, Harry at the back here, and then Tim at the front.
Harry Daniels, Live Squawk News. Is the MPC fundamentally split on its view about the future path for monetary policy, or is it just a matter of time before the MPC becomes one and decides to move as one as a group? Just with that in mind, you've had some archdoves come across to vote for a hike today, and therefore they obviously see something. You guys obviously see something that you see continuing into the new year. So is it just a matter of time before the whole committee just says, okay, this is now the time to raise again?
Well, it's, I mean, it's an impossible question to answer because, we just took a decision and every member of the MPC weighed on the merits. I would emphasize that, and is noted in the minutes, that those who felt that now wasn't the time to raise interest rates started from a position where they shared the exact same framework as everyone else, on the MPC, not just obviously in terms of the 2% inflation target in the remit, but that the core issue is thinking about this trade-off and optimizing this trade-off given we're in exceptional circumstances. And the differences in opinion, which you would expect with 9 individuals looking at a complex economy, are based on different views on the economic outlook and some of the relationships in those economy, and wanting, in some cases, more information in order to make those judgments. And as Dave said earlier, they'll have opportunity to go into that in more detail. So I wouldn't want to predict. In the end, the framework is the same, and we're going to be in exceptional circumstances for, a period of time, certainly until there's clear resolution of the future relationship, and even then, maybe longer than that, given the scale of some of the adjustments that may be required in the economy. And what's important is that people understand what we're trying to achieve, the sort of collective limits of tolerance in terms of that trade-off for the committee. And then different people will have different views on where the economy is going, the balance of supply-demand exchange rate, and monetary policy decisions will flow from that. And that way people observing the bank and people who are sitting on the committee can make their decisions. I'll make one last point, which just relates to the last thing that Ben said to Chris's question, which is, and this is an important point, is that one of the things that we had expected and hadn't fully seen in the data, but we're seeing in discussions with companies and in surveys, was that there would be some rotation of the components of demand over the course of this year away from consumption and greater weight on net exports and investment particularly. And that is now showing up in the hard data. It's corroborating what we had thought we had been seeing on the ground. And that is a very positive development, because it means the economy is operating. It's not operating on one engine, it's operating on multiple engines, and corporate balance sheets are in good shape. And as long as we have access to markets, those the export performance can continue. So that also plays into, obviously, our outlook in the decision in the reasons why we think the economy has momentum relative to its growth of potential.
Tim Wallace at the Daily Telegraph. Governor, can you tell us what needs to be done to boost the economy's productive capacity, and if there's any hints you've got for other policymakers on what they could do to help, sort of smooth that and push the economy onto the right path?
Shift that one over.
Not easy to answer. If you go back, when I mentioned that period back in whenever it was, 1860s, 1870s, when we last had a decade of no productivity growth, I mean, even 150 years later, so far as I can see, economic historians are still squabbling about what caused that. So the idea that we can diagnose it and cure it in real time right now is maybe too much of an ask. As it happens, when people talk about that period, they talk about the sort of pause between two big technologies. It wasn't anything to do with government policy. We were moving away from steam to electricity. I only say that because it's not evident that policymakers, wherever they are, can flick a switch and change this. If you ask most economists, they talk about sensible tax regimes, openness to the rest of the world, healthy public sector investment, good education. All these things presumably will help, but that's not the same thing as saying there is some policy switch that we can flick and give us back immediately the kind of 2% growth rates of productivity we enjoyed for so many years before the crisis.
But it's the last point on it. The last time we had a decade of negative real income growth was exactly that period, the 1860s, and so there's a corollary there. And I think Ben's point, which is implicit, which is that it does require sustained effort on a variety of fronts, and all those issues, obviously, as you know, Tim, are away from the bank. All we can do is, price stability, financial stability. Those are foundational, but the big issues are for others.
Richard, at the back there. Richard Barley from the Wall Street Journal. Governor, you've mentioned exchange rate effects a few times. Could you talk a little bit about how the MPC is thinking about this, particularly in light of, as Jason mentioned, global shifts in monetary policy that appear to be affecting exchange rates, and the UK's large current account deficit? How much of an influence is sterling having in your thinking?
In our thinking of what?
In terms of how you're responding in terms of interest rates. If interest rates elsewhere are going up, is the UK to an extent going with the flow?
No. I mean, look, the issue, the core, you know, I don't want to get super drawn on exchange rates. The core issue, which we've been addressing since the start of last year of 2016, when the referendum, it became apparent that there was going to be a referendum, has been the depreciation of sterling, which is the market's judgment of a real income shock, and it's that fact that it's a fundamentally driven move, by and large, directionally by a fundamentally driven move, which puts us in a position where we have been thinking about this trade-off and moving beyond.
Okay.
Eric Albert from Le Monde. You've explained today's increase as a fairly straightforward decision related to your inflation remit. I was wondering how much of a more long-term factor is there also in the fact that we've just been through 10 years of incredibly low interest rate. It was necessary, obviously, but it had drawbacks as well, possibly asset bubbles, savers being also suffering from that. The question I have to you is, how much do you think the benefits of the low interest rate period is now slowly outweighed by the drawbacks of that?
No, I mean, in aggregate, the benefits of running appropriate policy are clearly outweighing drawbacks. Drawbacks can be addressed by other policy instruments, whether they are distributional, although I would make a note here that actually over the course of since the crisis, for example, since quantitative easing was introduced in the United Kingdom, inequality both on an income and wealth basis has gone down in the United Kingdom, not up, on a quintile basis. On top of that, there's been 2.5 million more people put into work, which is, of course, the biggest contributor to improving distributions. There are issues. There certainly are issues that can emerge in the financial sector because of low interest rates, because of complacency around low interest rates. We have at this institution a range of other policies and powers to influence those. We are the regulator of the banks. We have macroprudential tools which we have deployed, and they are better targeted to some of the side effects. I mean, we need to be held account, obviously, to those, but swinging interest rates around to address those issues and having an economy that's not operating at its potential, having more people out of work, having inflation too low over time, at a time when there's still relatively high debts in the economy, not only is just off mandate, off remit, but it's counterproductive.
Hi, Kat Contigolia from Politico. I wanted to ask, so you've made it clear how if something good happens with Brexit, like we reach a transition deal or we understand what's going to be the next step, that would be taken into account by the bank and possibly change the policy and outlook. How bad do things have to be for you to take that into account? In October, we didn't get sufficient progress, but as far as I understand, that didn't impact the bank's assumptions on Brexit. So if by December, for example, we don't get anything, will that then be taken into account?
Well, thanks for the question. What matters, whether it's good or bad, is ultimately how it affects what businesses and households in the UK, how they react to it. So in general, Brexit is, for UK businesses, in general, there is a substantial proportion of those businesses, 40, depends on your survey, but let's call it something a little less than 50%, but something material, sort of 40 to 50% of UK businesses are affected by Brexit, and about half of those feel that it's a material effect, so it's materially affecting their plans, and that's shows up in the aggregate numbers now as we had long expected. But those businesses, in general, are not. They are anticipating ultimately an agreement. They are not managing to the absence of an agreement. They're anticipating some form of transition. They're not managing to the absence of transition. In general, there are exceptions, but in general, that is the case. So I say that to sort of ground my answer, which is that what matters to us is what people think is going to happen and how they react to it. So a little more progress or a little less progress will matter for the economy to the extent to which people change their attitudes and change their spending plans, and both positively and negative on supply and on demand. At some point, obviously, between now and the expiration of Article 50, there will be some form of agreement, or not, I suppose, but some form of agreement on both transition and on end state. And at that point, it is likely to be a focal point for people to stop, reassess, recalibrate, move forward, ideally, with some plans that have been delayed or deferred, and then we would take that into account. So things changing on the margin, I mean, we obviously track it, but it's not us sitting there handicapping a deal. It's what agents, if I can use that term, businesses and households in the economy think, expect, and how they react. And so our forecast has those reactions in there as people are behaving today.
This is the last question for today, I'm afraid. There's back there.
Adam Linton, Ranscorp. So my initial question was relatively similar to the one we've just had, but a lot of media focus generally kind of focuses on X amount of thousand job losses we could see in the financial sector. So in terms of you giving yourself a framework for determining how you could adjust your policy, could it be argued that ultimately the banking sector, they could eventually run out of patience at some point, and at that point that could be the catalyst for you to possibly act?
For us to act in what regard?
In terms of, as in preempt the fallout of any potential economic shock from deterioration Brexit scenarios.
No, I mean, for it to have a material macro effect, as important as the financial sector is, it would have to be more broadly across a range of sectors in order to, in my judgment, in order to have a big enough effect on the economic outlook that would influence policy. Because as important as the financial sector is, we're talking about the European component of the business in the financial sector. And I would add as well, if I may, just a sort of detailed point of explanation, which is that number, which is not a bank number, it's a consultancy number. It's in our view, it's a plausible possible number in the fullness of time, and very much in the fullness of time. It would require no future agreement with the European Union for financial services, and it would require a series of supervisory decisions made both in the continent and here in order for that to take place. So something like that is fairly far off the horizon. Certainly from a monetary policy perspective, it's not something we are sitting here as the MPC highly focused on exactly what's happening quarter by quarter, week by week with banks' business plans. FPC a little more so, but not the MPC.
That's all we have time for, ladies and gentlemen. Thank you very much.
Thank you.